Everyone in real estate talks about location, 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 which yes, it matters. But in this economy, that's not the most important thing. The most important thing in real estate is barriers to entry and replacement cost. So can a developer come in and build the same asset cheaper than what you bought it at? If the answer is yes, then you don't have the economic moat in industrial, especially small bay industrial today. And that's changing everything when we're looking at investing in this space. So when looking at location, we're really talking about where is your property located in relation to what the replacement cost would be to build that same asset today. This is really important. It took me a long time to actually learn this. And I've been in this 20 years. I have $400 million of assets under management. I live and breathe this. And real estate comes down to a simple formula. You've heard it back in your economics class, supply and demand. At the end of the day, that's the foundation of the business. So when you look at a property that you want to buy, and in that area where people are going to be, can someone else build that property cheaper than what you bought it for? And what we're talking about cheaper is the land costs, the engineering or the soft costs, all the entitlements, then the hard costs, the physical hard costs of actually developing the building, and then the lease up and tenant improvements. All those things, if they are less than the cost of what you're buying the building for, then you have trouble. And this can happen a lot, especially in states like Texas, where the zoning and permitting rules are very lax. And traditionally, it was a cheaper cost of labor. But if you can invest and buy a property right now that's within 20, 25 years old, and it is significantly cheaper than someone building one within 3 or 4 miles away, then you have that economic moat that you can keep your rents lower and you can probably stay occupied when that brand new development is going to have to charge premium rents because their cost basis is so much higher. It's a way to protect the downside and eliminate a lot of the risk. Now, I mean, why does this matter to you? If you're not a construction guy, right, I get it. But if you're a real estate investor, it's important to know what the replacement cost values are. And I don't have time to get into it fully in this video, but let's look at industrial real estate. There's a couple ways to build an industrial building. CMU is concrete masonry unit, meaning it's just a cinder block. Those types of buildings are built anywhere between $150 to $250 a square foot. I'm giving you ballpark numbers, but it's important to know that because if you're buying property under $130 a foot and you know it takes at least 180 or 200 bucks to build this other type of property, you're walking into that economic moat. You have that safety level that someone else isn't going to build something and then take all your tenants at a cheaper cost. When it comes to industrial, the next type of construction is a pre-engineered metal building, PEMB. It's a steel frame with a metal skin, and it's pre-engineered and manufactured at a factory somewhere, typically in the United States, and it's shipped out to the site and then erected. So these are going to be a little bit cheaper, anywhere between $120 and $180 a square foot, plus your land. And then the third type of building is tilt-up concrete. These can get expensive when it comes to smaller tenants. These types of buildings are where you pour the entire wall and you're going to tilt it up and erect the building like you're putting together a Lego box. These are very common in larger industrial projects, and that keeps the cost lower because you're putting up simple large walls. But when you start getting into smaller tenants under 5,000, 10,000 square feet, it gets very expensive, because you still have to build out all the demising walls and you have to incur the cost for the MEPs, the mechanical, electrical, and plumbing for every single unit, meaning the air conditioning, the bathrooms, the power meter. And they add up when you start getting 20, 30 tenants in an industrial park. So all that being said is your new development construction costs with land, with all the tenant improvements, all the demising walls and all of that could be 200 to 300 plus per square foot to build these small bay units that serve small businesses. So why is that important? Well, because you as an investor don't want competition. The competition is good for the next guy, not for you. So if you could buy something that is half the cost of what the competition would be if they built, you have an automatic return. You have that margin of safety, and that's what we look for. So with that being said, the cost of construction we know is typically higher than the acquisition cost to buy older product. And another thing that's actually fueling the opportunities in this space is developers don't want to build this stuff because, one, it costs a lot of money per square foot to build because of all those things I just shared. Two is because you're not dealing with a credit tenant. You're dealing with very small businesses that don't have national credit, and they may not be paying all their rent. You may have to churn through tenants to find a good tenant base when you're developing a property. And then three is it's a lot more work. 50 tenants with 50 leases, 50 improvements inside versus one big tenant that's one big box credit Amazon facility that you pretty much know you're going to get your rent paid. The developer is going to choose the big box every single time. It's not an opinion, it's just math, and it's just human nature, the path of least resistance. So that's why small bay industrial is constrained. We're not seeing the new supply like we are with every other industrial type of product being built right now. And that's going to continue to fuel the demand because small businesses are not slowing down. They're still growing. All right, so let's make this concrete. These theories are good, but how does the rubber hit the road? Well, for me, I have 2 deals in escrow, one in Houston, Texas, one in Dallas, Texas, and one of them's CMU, the other one's a metal building, and we're buying anywhere between $100 and $150 a square foot, and then doing the analysis in the area with land cost, all of the soft costs, hard costs, those for a metal building would cost anywhere between $180 and $220 a foot. So we're buying at a 40% discount. And then the CMU building would cost anywhere between $200 and $240 a foot. And we're buying that for a 50% discount. So checking the box that new supply, we are buying well below replacement cost. So that alone gives me a margin of safety that I'm comfortable with because that new developer can't make the math work. His new tenants he has to bring in, he's going to have to charge 40 to 50% more rent than what I'm charging at the property because I'm buying it a lower basis. My occupancy is protected, my rents are protected, the supply in the area is protected because the pure fact that the economics of the new product simply won't work against me. This is where it's really important. So where the replacement cost moat really earns its keep is in a soft market when demand softens and tenants, small businesses are negotiating harder. This is where the landlord who owns the asset at below replacement cost can offer concessions. Yep, we'll lower the rent for a year. We'll cut your rent down from 18 to 14 for 1 year, and then we'll raise the rents up in the future because I bought at a basis that's 30 to 40% less than the competition. So you have room to compete. The new construction can't compete. He's stuck. He can't offer those concessions. That's going to be the big difference, and we're experiencing that right now, is there's more available products in Small Bay, in Houston, and in Dallas. So the existing quality product at a lower basis can drop the rents. The brand new product, having to keep the rents high, and that's where you're seeing more vacancy. So to wrap it up, the most powerful position to be in real estate is not always having the best location. It's going to be the asset has the economics that are going to protect you from the competition. This is where the math prevents the competition from undercutting you and stealing your tenants and your investment dollars. So just focus on that number. What's the replacement cost versus where you're acquiring the asset, your basis? If you got a big discount and there's barriers to entry where no one can come around you and build something at 30 or 40% cheaper than what you bought it for, then you have that economic moat. You have that downside protection. That's exactly what I look for. Important critical thing before you open up any model or run any numbers, know these principles and you will be protected in your real estate investing. So if you have questions on what replacement cost values are or about industrial real estate investing or any other type of real estate investing, then click the link below or give me a comment and we'll reach out to you. I've been in the game 20 years now. My company's called Patriot Holdings. I'm obsessed with this. I love it. And if you've watched the video this far, you probably love it too. So reach out and we'll start talking real estate investing.